So hi all, this is Akshara Menon, analyst at PMS Bazaar. Today's topic will be on how to invest when markets are at all-time high. So whenever the situation happens, when markets are all-time high, we'll have a lot of questions. From an investor's perspective, we have a lot of questions. Is it good time to invest? Are the valuations are fair, or do we expect any downturn, or should we wait for quarter 2 results, or 2024 elections is going to affect the market? There's a lot of questions. So to answer them all, so we have a highly skilled, research-oriented professional, Mr. Nitin Agrawal, the CEO of Torus Oro PMS, a new age portfolio management service for HNIs. Nitin is one of the fund founders of Orowealth, a leading wealth tech startup that offers a comprehensive platform for investors to invest in multiple financial asset classes such as mutual funds, fixed deposit, P2P investments, stocks, alternatives, etc. He started Orowealth in 2016 and scaled it up over 1,000 crores of asset under advisory. Before founding Orowealth in 2016, he worked for around 6 years in the investment banking division of Deutsche Bank as a vice president, equity derivative structuring between 2009 to 2015. In this role of Deutsche Bank, Nitin was responsible for providing investment ideas and hedging solutions to institutional clients globally, and that role has been a familiar face in the global financial ecosystem. So welcome you to the show, sir.
Thank you. Thank you so much, Akshara. Thanks for the introduction.
For giving the podium to you, let me put a request to the participants to put the questions on the Q&A box and not on chat box, and not to ask any stock-specific questions. Now over to you, sir.
Thank you, Akshara. Let me share my screen and I'll talk you through. Thanks a lot, everyone, for joining, and thanks for your time. Let me first begin by giving you a quick intro about the firm and my team. So I am the CEO of Torus Oro PMS. Torus Oro is a JV between two companies, Torus Group and Orowealth. We started this JV in November last year in 2022. Torus Group is promoted by Mr. Sam Ghosh. He was the CEO of Bajaj Allianz, both general insurance and life insurance in 2000 to 2010. After that, he became CEO of Reliance Capital, which was the parent firm for Reliance AMC, which has become Nippon AMC today. Then in 2017, he left that and he joined Airtel as MD at Airtel Payment Bank. Post that, he left Airtel and he started his own company, the Torus Group. Torus Group is setting up multiple businesses across broking, wealth, PMS, and we've also filed for an AMC license. The license is pending with SEBI. To give you a bit of background about myself, prior to Torus Oro PMS, I founded my own company called Orowealth. This was an investment advisory company where we scaled the AUM to over 1,000 crores of assets. By education, I've done my BTech in Electrical Engineering from IIT Bombay and MBA from IIM Bangalore. Post MBA, I joined Deutsche Bank at the London office, and I worked there for 6 years. There, my role was covering institutional clients, giving them investment ideas and quant strategies. Some of our clients were like GIC, a Dutch pension fund. So I worked with a lot of institutions and learned a fair bit of things, how they manage their portfolio. So wanted to kind of implement those principles which I've learned, and I moved back to India and started Orowealth for that reason. I've also worked with very, very prominent people on the Wall Street. So my ex-manager, Tom Leek, moved on from Deutsche to head global quant strategies for Goldman Sachs. My other manager, Sean Flanagan, he's the global head of quant strategies for Morgan Stanley. So I've learned a few things from these guys, from big experts. So I wanted to share some of the knowledge with you today. Before that, I'll just introduce my team. So I have two people in my fund management team. One is Dinesh Gupta. He has been on the buy side for the last 20 years. He has worked with Plutus Family Office. He was part of the Marshall Fund, then Plutus Family Office, then Validus, and now he's joined us. Other person is Vaibhav Shah. He's a rank holder CA and CFA He was with L&T Treasury and Edelweiss. So before any further ado, let me move into the topic for today, which is how to invest when markets are at all-time high. So this is one question we've been getting quite a lot recently when we meet clients, when we meet investors, how to invest. So let's first understand why this question is coming up, right? So why is people are thinking that, why all these questions are coming? So one obvious reason is if you look at all the indices, whether large cap, mid cap, small cap, they are trading at all their all-time highs, near all-time highs. Also, if you look at some of the macro indicators, like everyone's favorite market cap to GDP, it's also at historical high levels. So obviously the question comes like, how should I go about investing? Should I invest in equity markets at these high levels? And macro is also showing that maybe not good time to invest in equities, levels are high. What should I do? So the way to answer this question is to go one level deeper. And one level deeper would be to look at the valuations. So if you look at any metric of valuation, so for simplicity, I've assumed, say, price to earning, which is PE ratio, on a trailing 12-month basis. If we plot the Nifty 500 or Nifty 50 or Nifty 200, any of the indices PE ratio over the last 5 years, we see today the valuation is actually less than the average over the last 5 years. So if the average is around 27 on Nifty 50, it's trading at around 22, 24. So on a valuation basis, it doesn't look very high. Whereas on the index level basis, it was very high. Further, if you look at one level more deeper, we are actually looking at the trailing 12-month PE. The right way to do it should be the forward looking. So if you look at a forward earning basis, the valuation will be even lower. So Nifty, instead of 22, will be at 20. The second thing which you have to be cautious about is all these numbers we're talking about is at index level. So even if suppose the valuations were high on an index level, but it's an average over all the stocks. So there will always be opportunities in some stocks which are undervalued and some stocks will be overvalued. So even in a market where levels are high, where valuations are high, there could be pocket of opportunities in some stocks which are undervalued. Also, we should be cognizant of the fact that this could be a period, like there was a period in US in 1980s and 90s, where the PE expansion happened for multi-years, which means that PE kept on increasing. And we may not be in a period where basically if the PE is high, then we should not invest because PE could itself keep going higher. So if you look at it, we started looking at the index level, then we looked at macro. We thought of looking at PE ratios as valuation metric, whether trailing or forward. We could look at some stocks. We could also look at how the growth is there. So there are a lot of these things which are looking at. The idea is that we should analyze it holistically. We should understand where we are across all these factors and then take a call. But are we missing something here? Because all these things we are talking about is valuation. Is valuation the only metric which we should look at? Do institutions look at this metric alone? And the answer is no. Actually, there are multiple factors which institutions look at before investing. And that basically brings us to factor-based approach to equities. So there are multiple factors. There could be a momentum factor, there could be a value factor, there could be carry or quality factor. What I mean by say momentum factor is, you must have heard recently say PSU stocks are going up. So you buy a PSU stock, you're doing a momentum-based factor investing. Or you say that like private banks are cheap today or IT is cheap today, so I'll buy IT. That could be a value style of investing. You buy high dividend paying stocks, which means you're looking for a carry kind of factor. Or you buy a quality company like TCS, which means that you want to have a stable income. And that could be a quality kind of investing. So these are different factors which are prevalent in the market. But how do this like factor investing came along is a very, very nice story. Factor investing became popular post 2008. And the reason for it is this. There was one large institutional investor, which is Norway Pension Fund. They have $1 trillion worth of portfolio, and they were truly diversified. They invest majorly in equities, and they were truly diversified. They invested across geographies, US, Asia, Europe. They invested across market cap, large cap, mid cap, small cap. They invested across different fund managers. What happened in 2008? All of them lost money, whether they were money in US, in Asia, in X fund manager, Y fund manager. So they said, like, what are we doing wrong? We were actually fully diversified. Why did we lose money across all the portfolio? So they hired one professor called Professor Andrew Ng from Columbia and asked him to do a research on their portfolio, like what is the right way to invest in equities. Professor Ng, I mean, the conclusion for Professor Ng was, you cannot diversify in equities by investing across geographies, by investing across large cap, mid cap, small cap, because the inherent underlying risk is the same. What you should actually look at by diversifying in equities is looking at different factors. And he defined certain criteria for a factor to be valid. So some of these properties of factor is basically, one, the factor should have positive expected return in itself. So for example, if one factor is a value factor, if you're doing a value strategy, you should expect to make positive returns out of it. Similarly, if it's a momentum strategy, you should basically have a positive expected return. Second thing is, these factors should be uncorrelated to each other or should have low correlation to each other. So typically when you see value factor does well, momentum will not do well. Because in value, you are basically buying stocks which are beaten down and expected to perform well in the future. Whereas in momentum, you're buying stocks which are doing well recently and may continue to do well. So there's inherent, basically, a low correlation between these factors. And third thing, and very important thing, is there should be some fundamental basis of whatever factor you're choosing. I mean, basically based on this, he kind of concluded that a portfolio should be constructed across all these factors, and that is the right way to invest in equities. So you should have some exposure to value factor, some exposure to momentum factor, some exposure to carry and quality and low volatility, which is like stocks having low beta or low vol. So this is typically the way large institutions look at their portfolio, and that's how they kind of manage it. All of us have done it in certain way. So some of us basically have bias towards value kind of factor investing. We start looking for low PE stocks. Some of us buy quality companies. So we are doing it, but not very formally. And what also happens is we miss the point that there's a lot of cyclicity in factor investing, which means different factors do well during different time. So here there's a chart from 2016 onwards till today, till September end, where we have plotted which style of investing or which factors did well during what time. So column say 2016, value was the best performer, momentum was next, quality was next, and Nifty 50 was basically one of the worst performers. So if you see, if it tracks in Nifty 50, it keeps going up and down, which is the green color. And it's not the best performer across any of the years. And if you look at the last 3 years, value style of investing has been doing the best. In India also, there is a very large bias among investors to do value strategy and a bit of quality. So typically, if you see a lot of fund managers, be it mutual funds or PMS, they talk about quality at good value or buying growth but at good value. So what we did is we did a back test across different styles in Indian markets from September 13 to September 20, so last 10 years data. And on the left hand side, you see the returns, average annual returns, CAGR, of across different factors which you can make in Indian markets. These are the standard factors. So what we found was momentum was one of the best performer with about 18% per annum kind of returns, whereas value was one of the least performers. In fact, below Nifty 200 and Nifty 500 and better than Nifty 50 by slight margin. Also on a return by risk basis, which means basically if you divide the return by the volatility of those returns, so sometimes you can call it a Sharpe ratio, value was one of the least performing style, which is where basically most of our clients or most of investors focus on. And they do not kind of look at other styles of other factors of investing, which are actually quite good performing. just to highlight that point again, as most of us have exposure to this either value strategy or a quality factor bias, most of us can improve our portfolio by adding exposure to other factors, because these other factors are having low correlation to value and quality, and also having positive expected return. So here what I have done, if you see the chart, basically the blue line is a Nifty 50 standard. Any large cap portfolio kind of will mirror this. If you just add 25% say momentum factor and 25% another factor, I just picked low beta or low vol, daily rebalance over last 10 years, in terms of return, it massively improves from 13.6 to 15.3. So over almost 2.5% kind of alpha. Not only it improves the return, if you look at the analyzed vol on the table, it has gone down from about 16.7 to 15.5. So it's basically giving you better return with lower risk, which is again highlighting the point that one should kind of have exposure to multiple factors in the portfolio and not focus on one of the factors. Basically, what we're trying to say here is, when you're looking at markets and saying that markets are at all-time high, you should look at your portfolio more granularly. You should look at it more depth. You should analyze, fine, markets are at high, but what is my exposure to? In my portfolio, do I have a lot of exposure to value, momentum, quality, low beta, what? Most often or not, you will find that your exposure is very high to value and quality, and you're lacking momentum. So one way to diversify within equities is to add the missing pieces in your portfolio, which will substantially improve your portfolio performance. What I also wanted to share is, we have kind of, based on these quant strategies, run a PMS fund. I want to briefly talk you through what we do in a PMS and help you understand like how do we kind of create this strategies. So we have a strategy called All Weather Portfolio. It's a rule-based quant strategy. It is based on the principle of momentum investing. So we picked the momentum factor because we thought that this is one factor which investors have very less exposure to, and we have created a portfolio management PMS strategy out of it. So first of all, we should understand why momentum works. What is the fundamental basis of existence of momentum? And the reason momentum strategy works in India is because there is benchmarking in the economy. What I mean by benchmarking is, there are fund managers who needs to benchmark their performance to any benchmark. For example, in large cap space, it could be Nifty 50. Imagine this, I have say HDFC Bank. HDFC Bank goes up for some fundamental reason. I am a Nifty 50 fund manager, index fund manager, because I'm benchmarking my performance to Nifty 50. The weight of HDFC Bank in Nifty 50 goes up. So to mirror the index, to benchmark myself to the index, I have to buy more of HDFC Bank. So the stock which went up for whatever fundamental reason, as a benchmark hugger or benchmark kind of fund manager, I have to buy more of that stock. So what is observed, and this has been written historically in research papers, that there is a short-term phenomena, short-term momentum in stocks which are doing well. They continue to do well because there's benchmarking. What also happens is, once fund managers start buying those stocks which are doing well, in our example, HDFC Bank, after some time, the retail investors start seeing, okay, this X fund manager is buying this stock, or this X fund is buying this stock. So they then start coming in and they start buying that stock. So what happens is, there's a short-term momentum, and stocks which are doing well continue to do well in, say, 3-month horizon or 2 to 3 month horizon. I mean, this phenomena you would have seen also, for example, recently is playing out in PSU banks. They are doing well, they'll continue to do well for some time. But what is important to figure out is, how do you figure out that there is momentum? So there are different nuances to creating the strategy. How do you determine which stock has momentum, which stock doesn't have momentum? And one of the very important point is, what universe do you start with? Because a lot of these quant strategies, they depend on data. And you need to be sure that the data is correct before you can make those calls. So for this reason, for momentum strategy, we start with a universe of only top 200 names. We don't go beyond top 200 market cap names in India. So the BSE 200 is kind of the universe of stocks. Even though our benchmark is BSE 500, we could beat that. But you can basically reliably run momentum on top 200 names in India because the data is proper, the stocks are liquid, the price actions are quick. Another important thing to look at is what kind of time period you look at for momentum. How do you weight the stocks once you have the momentum stocks? So for weighting the stock, the approach we use is called inverse wall weighted approach, which means the stocks which are more volatile have lesser weight. And what it does is basically it gives you risk neutral allocation, which means I'm allocating the same risk across stocks and not same amount of money. My money is less where the risk is more, so that the risk wise allocation is same. So these nuances are there to construct a strategy. But once you construct a strategy and have some risk management things like how much the stock can kind of concentration could be there, what is the liquidity benchmark, what is the kind of volatility kind of benchmark. So you have some risk management framework, you can get very, very good returns. And as this is rules based, you can also back test it over time and see how the strategy has done historically. So here, what we have done is it's a back test since 2015 end till today of our momentum strategy. It has given us CAGR of 20% per annum since that time. This is post all the costs. So this is post cost performance. And comparatively, in the same period, Nifty 50 was around 13%. And I mean, if you see on a sharp basis also, it's very, very better, much better than the benchmark. The same strategy has been live in our PMS, and we have real clients investing real money who have made this kind of return. So if you see last 6 months, so it's been live in November 2022 since we started this PMS JV, and that's why the 1 year return is not live. But if you see in the table, the 6 month return is a live return, and this strategy has done 33.9% return in the last 6 months. And mind you, it is only investing in the top 200 companies. So it's not that there's some small cap which has rallied a lot. It's basically capturing the momentum in the large cap space, in the large cap, mid cap space, top 200 companies, and able to generate this kind of return. Obviously, 33% is very high, but even in a long-term basis, you can say it can make 20% per annum. And the best part is basically it's kind of uncorrelated to most of the value or quality portfolio. So it will definitely add value to the existing portfolios of your clients. To give you a sense of what kind of companies come in. So if you see, this is a snapshot of recent basket of the momentum strategy. You will see some names like Bank of Baroda, you will see names like IDFC Bank, you will see like a Larsen & Toubro, all these Polycab. You will remember that these are companies which have performed very well in recent past, or Hindustan Aeronautics. Market cap wise, more than 100,000, like 1 lakh crore plus market cap, because top 200 companies, again, good ROC and ROE companies. But important point is it takes a 3-month view on these stocks. It's not like a long-term view. It's not going to say that like in 3 years the stock will double. Idea is to capture a short-term momentum, a 3-month momentum. So every 3 months the basket is kind of re-evaluated. If the momentum is still there, it's retained. If the momentum is not there, the new names come in. In terms of the sector allocation, right now is about like 30% plus in financials. Another important thing to highlight is momentum is actually in a way sector rotation. What happens is sometimes some sectors work, some sectors do not work. And when you're capturing momentum, you effectively capture that sector rotation. So you will see large allocation to one sector, but over time that sector may go away. So for example, right now our strategy is allocated to financials and a large allocation to financial industrial, which have been doing well recently. In terms of performance, market cap allocation, again, because of top 200 companies, almost 50, 70, 60% is mid cap and 40% is large cap. There's no small cap in this strategy. Performance wise, last 1 month return, in fact, September return, it's 6.5% versus BSE 500 of 2.1%. This is September return. And this will be one of the, top quartile or top end return across all PMSs last month. Last 6 months is 33.9. And since inception in November 22, it's up 22% versus benchmark of 12%. So it can really add value to your portfolios. So yeah, I mean, this is what we wanted to capture. This is our contact email ID and phone number. Please reach out to us in case you'd like to discuss more in detail. We'll be happy to get on a call. But really, the message we wanted to kind of convey is you should look at your portfolio in a factor manner, where what is the exposure? Are you just buying, say, dividend earning stocks? Are you just buying quality stocks? Are you just buying value stocks? Then you should look to diversify, because adding different factors will not only increase return, it may also reduce volatility, which means you'll be able to hold to your portfolio for longer and generate that compounding return. So yeah, I mean, that is it from my side. Happy to answer any questions if you have.
Thank you, sir. That was a elaborate one, little PPT, I must say. And of course, we'll have few questions. Let me take the question from the there was one question. This one: what's your opinion on infra sector in next 5 years?
Okay. So infra sector next 5 years, I mean, if you look at what government has done over the last 4-5 years, it has been phenomenal, and it's going to happen. Because we are at a stage in our economy that basically the growth is dependent on the infrastructure quite a lot. There's a lot of bottlenecks, be it logistics, be it highways, be it railways, and a lot of work needs to be done. What has happened is at least the government has started moving and thinking in that direction. The capex which is government is doing is like grown like 3-4x over the last few years, and is going to continue to perform. So infra is something which is going to do well. The problem in infra is also very risky in that sense. It's very company dependent or stock dependent. So we typically, don't advise on all the stocks in infra. It's very selective because you need to kind of work with credible names. I don't want to take a name, but some of the large companies are very, very good and are poised to kind of perform very well. We have them in our portfolio, but you cannot just go and buy any single stock in infrastructure because there are a lot of factors. Right? Like from in terms of, say, if you're doing a project, what could happen is just getting the land or like resettling people. All these things can kind of destabilize the projects. So it's very important to kind of work with very credible players, and that way you can kind of get returns. But overall, very, very good sector to kind of have exposure to.
Yeah, thank you for that. But what of your PPT? In one of the slides said that, last 3 years, it was value investing which was topping the list.
Yeah.
So what do you expect? Like in next year, are you still going to hold on the value investing part, or are you going to shift your strategy to momentum investing?
No, so actually, that's a very good question. The whole point is that there is cyclicity in factors. One factor which has done well may not do well in the future. And you cannot just say, I'll hold value because it's doing well. In fact, the whole point was that you should hold other than something value because it has done well recently. It's very likely that some other style will do well. So we believe that in the next, say, short term, 6 months to 9 months, momentum should do very well. Low vol should do very well. So and value much less so. On a longer time frame also basis, if you see, value has not given that kind of returns as some of the other factors. So we would kind of overweight towards momentum or low vol versus value.
So when you talk about that, when you talk about stock selection now, so apart from knowing whether it is an value stock or if it is in a momentum one, apart from the cyclic factors, what are the other parameters or what are the other financial parameters that you want to check before it enters into your portfolio?
Yeah. So I'll take a step back. Basically, in our PMS strategy, we have two different strategies. One is called all weather, which I described, which is quant-based, momentum factor-based investing. There's another strategy called alpha compounder, which is fundamental-based, which basically takes a longer-term view. So in the fundamental strategy, which takes a longer-term view, we obviously look at multiple factors of investing before investing in a stock. One of the factors which we look at is, first of all, the market it is operating in. Is there some structural growth story which is happening in the market? Is there some mega trend which is going to help that like all the stocks in that market. For example, say, China plus one theme is going on, or there is Make in India theme, right? So what are the market forces which could propel any player in the market forward, right? So that is very important to know where the market is growing and why will the market grow. Once you have that figure out, then basically it's important to look at which player could win in that market. So then the whole point is whether they have a moat. It could be a distribution moat, it could be a product moat. What has been their capital management? Are they good at making ROE, ROCE historically? What has been the management commentary? Is their management credible? So all those things they evaluate and then figure out the player which you want to back in that space. But for us, the most important part is to figure out the right market.
Okay. So I have one more question to ask from Shaksham is that how does low beta stocks provide excess returns compared to CAPM?
So there is research about it, and one of the reasons for this is basically because there is leverage in the market, and I'll explain that connection. So if you see what happens in the market is there are some people which can invest long only. They cannot take leverage, whereas there are some players in the market who can take leverage, who may go long short or they may buy by borrowing some money. So if you're a long only player, and if you're buying basically low vol stock, what happens is because it's low risk, it's also low return. So for example, it will give a 10 to 12% return, but at low risk. As a long only manager, it's very difficult for you to buy that stock because you will only make 10, 12. So you want to also low risk, but you also want certain return which is higher than benchmark. So what happens is typically these low risk stocks are kind of not bought enough. And that's why there is like an anomaly in the market where, because as a player, you can invest in lower, you can get that excess return because a lot of players will not be able to do it.
Okay, so there's a follow-up question also. When you rebalance your portfolio on a daily basis to keep the exposure constant to your factors, won't it increase both the transaction cost and short-term capital gain tax?
Yeah, so it's a trade-off. It's a trade-off in terms of how quickly you want to rebalance the portfolio versus the transaction cost. And what we do is we try and optimize it. So obviously we do not do daily. Daily is more of a hypothetical construct to figure out what works or not. In reality, it's more closer to quarterly than daily. So that basically the costs are managed. And also we need to understand is that it's not that even if you do it quarterly, the changes will happen. There's a lot of stocks where, for example, in case of momentum, the momentum will continue over 6 months, 9 months, 1 year. For example, defense companies, right? There's been momentum for quite some time. So it's like a check which is done quarterly. It may or may not result in rebalancing, but definitely doing it daily will be too much transaction cost. So you need to kind of plug in the model, figure out where the optimal point is. And for us, it has been quarterly.
Okay. So like when you're relatively new to PMS industry,
Yeah.
so we have more pennies in this PMS. So where do you see the gap? Like why do you think the investors should to choose Oro, Torus Oro when we have other pioneers in the market?
Yeah. So that's very important. So first of all, one reason, one way to differentiate is if you have a very large fund in a PMS environment, it's very difficult to take calls. So if you would have seen some of the larger players, it's very difficult for them to perform in the market because for them, a significant portion of the market is kind of very difficult to move. For example, if I have a 20 stock portfolio, PMS is typically like a very small concentrated portfolio, not like mutual fund where you can have 30, 40 stocks. If I have 20 stock portfolio, I'm managing a 5,000 crore fund, probably having 500 crores in each stock. Automatically, my investment universe reduces. It's very difficult for me to kind of rebalance because I need to have a lot of other constraints which come in. So in a concentrated portfolio, it's better to have a smaller or a mid-cap or a mid-size PMS manager because it's easier for them to create alpha. So that is one general kind of reason for going with smaller or mid-size PMS managers. Specifically for Torus Oro, what we are trying to offer here is something unique in the sense that if you see most of the managers, they will be either value-oriented strategies or quality-oriented strategies, where the difference is very less. Whereas for us, is a momentum strategy, it's a 3-month view. I mean, a lot of clients, if you say that I do not want to invest in right now because valuations are high, I may wait for a correction. But our momentum strategy is a 3-month view. And you may not actually need to wait for correction because it will take a kind of a position in something which is performing very well. So, for example, September month, last month was a very good example. Most of the PMS fund managers would not have done very well. It could be plus 1% or flattish, whereas we could make 6% return. And the reason was that in our portfolio, we had something like PSU banks, some railway stocks, etc., which have done very well. So there's always opportunity on a 3-month basis, and it's very, very differentiated versus majority of the PMS offerings. So that is the second thing. Third thing is in terms of basically our team. If you see, I mean, we are very, very open in terms of our transparentness of process. What we have seen is some of the competitors, it's very difficult to even get time from some of the fund managers. So that is the third thing which we very differentiate on.
Okay. When you say, just a continuous question, when you say alpha generation, of course, your all weather portfolio have given good alpha. And in spite of, we had a COVID, we had Ukraine-Russia war. After that, we had the US Fed interest rate hikes, and of course, prestige in US. In spite of everything, it gave a good alpha, it was a stagnant one. So, what was that that pulled the strategy up?
So, see, the important thing in this all-weather strategy is, again, as I said, it's like a short-term view. It's a 3-month view. It's more tactical view. It's not a long-term 5-year view. What happens with some of the fund managers is because they take a long 5-year view, they need to wait for the performance to kick in, and that set of portfolio works in certain environment. So you would have seen some of the managers were not doing well for 2-3 years. And suddenly they start doing well when the environment becomes right for their portfolio of stocks because they've been holding on to it for a long-term view. Whereas in our case, because it's changing very frequently on a quarterly basis, it's kind of designed to work in that environment which is existing right now. So even if the say stocks are not favorable for this today's scenario, in the next 2 to 3 months, it will start kind of rebalancing itself to attune itself to the current market conditions. So that's why basically, I mean, it kind of outperforms in kind of all the market. Yeah.
How do you decide the factor that weights the portfolio?
Okay. So factor weights actually, it depends on basically each client. And the reason, I mean, because each client's portfolio could have different exposure to different factors. Some clients could be like 100% in value factor, right? So for them, it's easier to take a call that I want to add substantial portion of momentum or quality. Some could be already 50 value, 50 quality. So that's why it's kind of different across different things. Typically, what I've seen is people want to start with some momentum. They may not allocate everything to momentum on day one, but it'd be good to have exposure to both value, quality, momentum in the portfolio.
Yeah. So the next question from Kanishka is that how do you identify momentum building in a stock?
Okay, so I think that is the key. That is a very key question because one thing is first we have to understand that we need to invest in momentum-based stocks. Now, how do you identify what is the momentum, where's the momentum? And good thing is there's been a lot of research in Journal of Finance, published research across markets, across global markets on how to identify the right momentum stocks. And there are various ways. I mean, it could be a 1-month momentum, 3-month momentum, 9-month momentum, 12-month momentum. You could look at Sharpe ratio, you could look at drawdown, etc. Ultimately, it's a kind of you can think of it like you need to figure out the market you're operating in. So basically, for Indian markets, we've done a lot of backtesting, a lot of data-based kind of optimization to figure out what metric works for identifying the momentum. For us, I mean, we have been looking at last 1 year data to kind of infer. We don't go beyond last 1 year data to identify the momentum. But within that 1 year, we think there is enough kind of data to figure out which stock is kind of going to have good momentum.
Okay, so next question from Devendra is that will the current momentum of the market continue in near term?
So current momentum in the market will continue. So again, I mean, it depends from, like, there are different pockets, right? So overall index level, it may not do well because obviously there are multiple factors which is affecting, right? So one is crude oil prices are very volatile. US rates are going up. So FII start pulling money out. Plus overall India long-term growth story is intact, right? So there are various factors at the index level, right? But as I described, that is an index level that may not be for us to look at. We should be actually looking at our strategy and our kind of stocks, and we'll always find a pocket where there will be momentum. So, for example, right now we're finding momentum in PSU stocks, which will continue to hold. So even if the index may not do well, maybe PSU stocks momentum will continue for some time. So that is what we think.
Okay. So the next question is from Pratish. Is the market overvalued? And is it a good time to invest lump sum?
Yeah. So I feel, as I showed in the slides earlier, the market is not overvalued. Even historical basis, the basically valuations are below average, historical average. Simultaneously, if you look at the forward kind of projections and the earning growth which is expected in Indian market is going to be humongous. In fact, we are at a kind of a, like, once in a lifetime opportunity or for a kind of a nation, right? So because all the demographic dividend is going to be in place. If you see, we are where China was in 2006. So the next 10 to 15 years is a place to be, and equities will going to do very, very well. So it makes sense to be allocated in equities for sure, even at this level. What also matters is whether you want to invest in kind of index level or find your stocks. In terms of investing in equities, for sure you have to invest. Is just be careful in terms of what is your style of investing and make sure that you understand what you're buying.
And next question from Vinayak is that what is your exit strategy?
Exit strategy, okay. So exit strategy, again, because its momentum base is very easy. So every 3 months, basically all the stocks are evaluated on whether the momentum is there or not. If they are able to sustain the momentum based on proprietary factors, we continue to hold them. If they're not, we change them. So it's basically every kind of 3 months, the basket is kind of rebalanced.
Like, is there any example that you could take from your past experience? Like, is there any stock that you have retained for long? Because you always mentioned it was a quarterly basis rebalancing.
Yeah.
Have you ever maintained for a stock for long?
Yeah, for example, defense companies. Some of the defense companies has been a portfolio for quite long because that is one kind of trend which is going on and is expected to kind of do very, very well in the future also. I mean, the momentum is still there and we continue to hold them. For some of the ones which we exited is basically something like IT, which lost momentum at some point, right? So I mean, it keeps changing over time.
So you don't have exposure to IT in your portfolio?
Not much right now. Yeah, it's very low, right? It's more financials. Today, it's more financials and industrials. Okay.
So next question from Prashant is that is there optimum balance of factor weights that system should design in a portfolio?
Sorry, come again.
Is there any optimum balance of a factor weights that a system could design in a portfolio?
Yeah, so see, it depends on what kind of risk you want to take. So it's a kind of an optimization on the risk level. So because say, for example, if you add momentum, it's slightly more volatile than say a quality or a low vol, right? So if you want to have a Nifty like volatility, 18% kind of volatility, you can add more of momentum. If you want to have lesser volatility than Nifty, you need to add a bit more low volatility, low beta. So it's basically to first figure out what risk level you're comfortable with. If you're comfortable with like a Nifty kind of risk level or lesser, and then you kind of figure out the way to invest in. Yeah, but just imagine if there's if market is less momentum, momentum less. So do you sit on cash? Like, how aggressive are your cash flows? Yeah, so we have seen in the past there are certain movement in the market where there is no momentum at all. So typically it doesn't happen because obviously there's a large universe and there's always some momentum in some stock going on somewhere. But it has happened in the past a couple of times where there was no kind of momentum based stock. At that time, a strategy kind of goes into cash. It could go up to about 25-30% in cash at that time. when the momentum is very, very low.
Okay. But what are the factors that drives the market? What do you think? Because when you talk about momentum, so the factors would change along with the market. So what are the factors do you think would drive the market?
So see, ultimately, it's all driven by economic cycles, and there are large economic cycles. For example, say IT sector, right? So there is what is happening in economics driving IT stocks. Large buyers is US banks. US economy is not expected to do well, so they will not do well. In IT stocks will not do well, right? So there is large economic supply demand kind of factors which drive different sectors, and there is sector rotations. But these sector cycles are very, very long. What happens is in a short-term basis, there is fluctuation in the stock level. So ultimately, the inherent driver is economy and economics. But over time, because there are multiple other factors in terms of flows, supply, demand, etc., which may drive the stock prices. And the best way to kind of channelize all this is to have a diversified exposure across all factors, because it's again very difficult to time which factor will do well at what time. But this is one of the ways to diversify your portfolio in equities, to have exposure to multiple factors and not just focus on one.
So what are the what are the sectors that you looking upon for the next, because when you rebalance for every quarter, so I can ask, like, for next quarter, what are the sectors that you're bullish on?
Yeah. So see, let me talk from a fundamental perspective in terms of fundamentals. In Indian economy, industrials look very, very good right now. As I said, there is structural growth story which is happening. There are a lot of mega trends. China plus one theme. There is PLI scheme. There is Make in India scheme. So all these are kind of leading to a lot of like tailwind for this sector. There are multiple companies in this sector which are doing very, very well. Some people may think that the valuations have run quite high in this sector, but there's still opportunities because the growth is so high. For example, one of the segments we like is waste recycling or e-waste recycling, because that is, all the kind of electronics, everything has come in the last 15-20 years. Now is the time to kind of figure out how to dispose that, or how to dispose that effectively. So the companies in this segment which will benefit from this entire trend of e-waste recycling, right? So you are in a market which is going to do well because of structural reasons, and then we need to figure out which is the best player who can play that opportunity. For example, there is this new segment of EMS, electronic manufacturing services. This is again going to have like a big run, because this is something which is getting helped by China plus one theme, where US players want to diversify away from China. So looking at players in India. Industrials is a very, very kind of good sector to look at.
With that, let me move to the next question. What was the split of factor weights in backtested portfolio that showed 20% CAGR?
That was just momentum. So the one I showed you, 20% CAGR, was a pure momentum strategy. And it was basically what we are trying to say is, in our PMS, we run a pure momentum strategy. And because our investors' portfolio or clients' portfolio already have exposure to a lot of value and quality, you can just invest in this PMS strategy, give some allocation of your portfolio, say 10%, 20% of your portfolio to this momentum strategy, which will not only increase the expected return, but will also reduce volatility of your overall portfolio. So a lot of family offices are looking at it that way. Okay, I hope,
Prashant, your question is answered now. So moving on to the next question, Mani has asked, what is the scope of stocks, Nifty 500 or by market cap? How do you
sorry,
what is your scope of stocks? Is it Nifty 500 or by market cap?
No, so basically our benchmark is BSE 500 or Nifty 500. But in momentum strategy, we only select stocks from the universe of top 200. So BSE 200 is the universe and BSE 500 is the benchmark.
Okay. When you have two strategies with you. One is alpha compounders and others all weather.
Yeah.
So to which kind of a client or to an investor you would prefer a all weather, or to whom do you suggest alpha compounders?
Yeah. So alpha compounder is the fundamental strategy where we basically buy long-term growth stories at good valuation. This is something basically where client has a long-term view where they are looking to kind of have exposure to certain themes which are not there in the portfolio. Like, for example, I mentioned waste recycling, or for example, EMS manufacturing. So we kind of create a portfolio where they can buy companies which are very, very high growth, expected to do basically 18 to 20% per annum kind of return over time based on long-term story. So they need to have a long-term time horizon. They need to be having 3 to 5 year plus kind of horizon to invest. What all-weather quant strategy is again like a short-term tactical kind of strategy, which is a good overlay to your core portfolio. So your core portfolio is already say a Nifty fund or like a value strategy, but you can have an overlay of momentum strategy to diversify.
Okay, so let me take a question from participant. Hi, what would be the market impact of election outcome? Should we invest now, or should we wait for the election to conclude?
So one thing is because elections are near, there could be certain actions from the government side. There could be policies which may result in basically more populist measures, right? May not make a lot of economic sense, but could be populist. So we have to be careful about that. And what we have seen, I mean, in the past is typically in the run-up to election, the markets are doing well. It's a factor to watch out for, like typically what government does in the run-up to election, and hopefully they should not have a lot of these loose fiscal policies and continue to work on the good development path they're working on. So if that is there, then we should not worry about it. The election event, the election result itself is very volatile and it's difficult to kind of predict. So typically you should not take an event risk because event risk is something, it's not professional to have a kind of, you can never get good payout on an event risk. So typically you should hedge your bets for a particular event. But in the run-up to election, we are still positive unless you start seeing signs of government having populist policies before election.
So when you say the you can predict and along with the events, when you come up to the cyclic factor, how do you allocate the capital of an investor? Because for a long-term perspective, because it's like when you say it's contradicting, when a long-term investor comes with you and you go for short-term calls, short-term calls. So how do you meet those joints?
Yeah. So, see, investor ultimately is, I mean, who is investing in equities is investing from a long-term perspective. When you look at momentum as a kind of an allocation to your portfolio, you need to see it as a diversified or existing portfolio. So you are adding something which is going to add to your returns and reduce the volatility over the long term. But that strategy itself is a short-term tactical strategy. The reason it's short-term tactical is the reason why it has low correlation with your existing portfolio, because most of your portfolio is long-term. So as a long-term investor also, you can have allocation to short-term strategies because it's a kind of a core portfolio is something on value and quality, and there's a satellite portfolio which is having this tactical momentum strategy. So even from a long-term investor perspective, it makes sense to allocate to multiple factors.
So how do you maintain the liquidity in the portfolio? How's the liquidity maintained actually?
So liquidity is actually quite high because these are like stocks of top 200 companies. And typically we invest about 95-96% of capital, and 3 to 4% is cash. But beyond that, it's very easy to kind of get in and out of these stocks because these are very, very liquid stocks because they are top 200 companies in India, not a small cap which has very low trading volume.
So what is the USP of the fund? Like, what makes this fund differs from the other fund in this industry? Because we have a lot of funds which is going to follow this strategy. So how does Torus Oro is being different?
Yeah, so one is this whole style of investing. Not many, I don't know many PMS funds which are running this kind of strategy. Second is performance. If you look at last 6 months since we have been live, it's up 33% on a top 200 stock investing basis. So not via any small cap exposure. So it's very good in terms of performance. It has a good fundamental basis of existence. Plus it's a good diversifier to your portfolio. So it definitely makes sense to add to your existing portfolios.
So if you could explain on your, because one of the participants asked about your fee structure. If you could tell that.
So we have two fee structures. One is a fixed fee, which is 2% per annum. All the returns I have mentioned is post cost. So the 33.5% return study is given is post cost, post this cost. There's also a kind of a profit sharing alternative model. If clients prefer that, we can have that. So it has lower fixed fee and then some profit share.
Okay. And when you talk about asset allocation, so what do you think is the ideal asset allocation for the current market scenario?
See, asset allocation is again at a client level, right? It depends what is your age, what is your goals, what you're trying to achieve with the market. So for asset allocation, determine asset allocation, one should always look at what I'm trying to do. For an HNI who already has a lot of wealth, maybe the goal is to beat inflation. They should not try and kind of out from the market. Someone who is very young, started investing recently, they may have a lot of kind of room to go and they can take very, very long-term view, should have more allocation to equity. So once you've figured out your ideal asset allocation, that, okay, I want to be like a more debt investor or equity investor, within that, the way to look at it is, you should have exposure to multiple uncrowded asset class. So one is equity, one could be bond, one could be gold. So a lot of people don't allocate to gold, but gold is also a very good diversifier across equity and debt. Fourth bucket could be the foreign assets, because I mean you need to have exposure to currency also in some way. So you look at different baskets and see where it fits based on your goals and time horizon.
Okay, thank you, sir. With that, we've come to the end of the session, and we've got because we've got a huge response, and there was one compliment for you as well, from Hedges saying that that your insights for this webinar was very useful for them.
Thank you.
Thank you for that. Thank you for your time, sir.
Thank you, everyone. Thanks for joining.